All right, so in this video, I am going to teach you one of the best 1 minute scalping strategies that you can use right now. It works really well with gold and it also works with NAS 100 and other like futures, right? But I primarily use it with gold and sometimes also with NAS 100, and it works phenomenally well with crypto as well. But today in this video we are going to be focusing on gold. All right, so what exactly is the strategy? We're not going to be using any other time frame. We're going to be sticking to the 1 minute time frame, right? And the very first thing that you have to do is wait for price to push in one direction, right? So let's assume that we have a push to the downside, right? So you see price pushed to the downside. Now, what I want to see is a pullback, okay? So I want to see a pullback. So we have a push to the downside, right? It could be pushed to the upside or to the downside, but in this scenario, we had a push to the downside. And we're looking at the 1 minute, and it works on all sessions. So you could trade Asian, you can trade London, and you can also trade New York. But be careful about the high impact news, okay? You always want to trade after the high impact news. So for example, if there's a high impact news during the London, you want to wait for the news to pass out. Then if there's a high impact news during New York, you have to wait for the news event to pass and then you can trade. So let's assume price pushes down and creates a low. Then we have a pullback. Now at this point, what we have is our range low. So this right here is what we call range low. So I am going to mark this out as range low. Okay, and now what we have to do is identify the range high, but we simply can't do it that easily because let's suppose you could say that this is a range high, but it is not, and I'm going to explain to you why. Okay, so in order for this strategy to work, we must have a valid range low and a valid range high. And similarly, if I inverse the chart, we need to have a valid range high, right? And a valid range low. So I'm just going to invert back. So how do you actually identify the range high? Because we have identified the range low, and we do it by seeing price move in one direction with a good amount of momentum. So we push down, right? And then we pull back up. Now, how do you identify a range low? So range high. How do we identify a range high, right? We want to see a market structure shift. Okay, so we had a low that formed here, and then we had a pullback, and then we had a market structure shift within this pullback move, right? So you see this, right? We have a higher high, higher low, higher high, and then a market structure shift. So now, when we get a market structure shift, this high becomes our range high. Why? Because this high caused a market structure shift to the downside. All right. So now we have a range low, and now we have a range high. Right. Now the second step for this range high to be valid is you need to use your Fibonacci from range low to the range high. And this move must come back to around 0.5 level. When we have a significant market structure shift, it must reach the 0.5 level. Okay, that is rule number 2. Otherwise, the range high is not valid. Let's suppose that you get a market structure shift, right? But price never reached the 0.5 level. Now, in that case, the range high is still not valid. However, when we reach the 0.5 level and we also have a market structure shift, right? Then we have our setup ready. So we can basically just look for the next step. So we have a range high, right? This right here, and range low. Why this is a range high? Because it reached the 0.5 or 50% of the range low and range high, if that makes sense. So now the next step is if we are bearish, we see that we have been bearish on the 1 minute time frame. Primarily, and if this is not necessary, okay, this is not necessary, but primarily I want to see the range high taken out first. Okay, because in that case, then we would be trading with the trend, and it increases our probabilities to some degree, not by much, but to some degrees, right? Or what can happen is we take out the range low first. So let's assume that we take out the range high first, right? So we push up, and then we take out the range high, and then we get a market structure shift, and then you can take your entry. Okay, so your entry could be from auto block, and I suggest you take your entry from the auto block, right? Consecutive bullish candle, or if there's a singular candle, you take your entry from that. It's gonna provide you with entries you're not gonna miss most of the time, and in some cases, it will give you better risk-reward ratio as well. Or you could be patient, and then you can take your entry from the extreme fair value gap. Or other way to enter is from the retest of the range high. But I suggest you use auto block. So let's say we took our entry. We are going to be targeting the range low. This is going to be our final TP, but what you have to do is use your Fibonacci from range low to range high once again. Now, after the entry, when price reaches the 0.5 level, that is where you are going to take one partial if you are getting at least 1-to-1 risk to reward. If you are not getting at least 1-to-1 risk to reward when price reaches the 0.5 level, you are only going break even. But if you're getting 1-to-1 or more risk to reward at 0.5 level after your entry, then you can take one partial and then you can go break even. But then again, if you're not getting 1-to-1 at least, you just go break even, because at the end of the day, we want to make more than we lose, right? And since we are on the 1 minute, this is a very, very fast moving time frame, right? So we want to be in and out of the markets, and we want to protect our capital as well. And we do that by going break even at 0.5 level. Now, what you can do is you can hold till range low, or there's another technique that I use, and I use the 0.79 level to close my entire position, because sometimes price will actually reverse from this level. Okay, so there are three things that you can do. You take one partial at 0.5, and then you close your entire position at 0.79, or you take one partial at 0.5, and then you take your second partial at 0.79, and you close the rest of your position at 1. This is what sometimes I like to do. Okay, very simple. So let's flip the chart over, and I'm going to show you. Let's assume that the range low is taken out first, right? And we push to the upside. The same rule applies. So we have a lower low, lower high, lower low, and then a market structure shift. Now we have the range high because we had a push to the upside in one direction with a good volume. And let me just do this real quick so it's not confusing. This is our range high, and this is our range, low. Okay, so I want to put it bottom. So push to the upside. Now we want to identify range low, and we do so when we get the first market structure shift. Lower low, lower high, lower low, boom, right there, right? And then we wait for price to sweep this or range high. So in this example, you can see the range low was swept first. Then the very important part of this strategy, guys, this is extremely important. When we get a market structure shift after the range low, range high is taken out, we want to see price come back and close above the range. This is very important, because if price gives you a market structure shift here but is not closing above the range low, then we are not going to take our entry unless price closes back above the range, and then we can take our entry from the retest or some form of PD array that is present here, and then the price is going to go to a zero direction. Okay, now I know this is a bit complicated. It may seem complicated to you, because for me it is not, and for some it may not be complicated as well. But if you are someone and you think this is complicated, please keep rewatching the video, because what I'm saying is exactly what you should be doing with this strategy. So let's assume you get a market structure shift. That is your first step. Okay, then we close back above the range. That is your second step. If you're already in the range, that's totally fine, right? Then you take your entry from the auto block, and then you can see how price goes up. And the same risk management applies to this model as well, right? you take one partial at 0.5 if you're getting at least 1-to-1 risk to reward ratio. You go break even right away when 0.5 level is reached, right? Then you take your second partial or close your entire position at 0.79 if you are at least getting 1-to-2, right? You can close your entire position at 0.79 if you're at least getting 1-to-2. Remember that. But then you can only take the second partial here and the entire position closes at range high. Okay, so that is pretty much the entire model. Just make sure that you are trading during the sessions, which is the Asian kill zone, the London kill zone, the New York kill zone, because that's when you're gonna see these ranges formed, right? So usually during the London session, you're gonna have big moves, right, with high volatility. But when the move is over, price is usually going to start ranging, and that's where we want to look for opportunities, right? Also, during New York session after 9:30 is when price will give a big push, right? And then at around 10 or something, price will start consolidating, and that's where you have to find your range, and then that's where you have to look for opportunities to take your trades. Now I'm going to give you guys some examples, and I'm going to teach you by showing you live examples, right? And that's going to solidify the things that you are learning from this model. Let's move on to the examples now. All right, so in this example, you can see we had a push to the upside, and then we had a significant pullback, right? So that's our range high, right? And let me just close that. So we have our range high over here, but how do we identify a range low? What we have to do is look for a market structure shift within this pullback move, right, to the upside. So we have a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. But notice what happened here. Lower low, lower high, lower low, lower high, lower low. So it can be internal structure as well. All we need to see is this type of pattern occur. Okay? This type of, and I don't care if this is internal structure or external, but you can see we had this high over here, and once it gets broken, that is when I consider this as my range low. I do not have to primarily see a significant lower high like this or like this broken. It could be just a small, a fractal level high within the structure. But the only pattern that we have to look for is this. It can't be this though. So for example, this. It can't be this. We need to create a low, right? This is not what determines a range low. This is not a range low. Why? Because we have a higher high, higher low, higher high. And this is not a valid market structure shift. This right here, lower low, lower high, lower low, and that. Boom, right there. So you can see over here, we have the same pattern. Lower low, lower high, lower low, boom. So I hope by now it's clear, right? I know it may sound a bit complicated, but trust me guys, it is not. So we're waiting for price to take out the range low. We take out the range low. We have a pullback to the downside, right? Lower low, lower high, lower low. And then we are waiting for a market structure shift. And right here, you can see we want to see a body closure. So over here, what do we have? We have a body closure to the upside, right? That is what we have to look for. And we also closed just above the range. So now all we have to do is just simply wait to see if the range is valid. You can see it is valid. Why? Because from this low to this high, we reached the 0.5 level, right? So that creates a range valid. So we closed above the range, and now we will be using this auto block for our entry. So you can see right there, this is the lowest consecutive bearish candles. And price came back, retested our auto block right here. That would have been your entry. Stop right below the auto block. First partial at 0.5, and you can see we were getting 2.87 risk to reward ratio, which is crazy. Now, this could have been your first partial, or you could have closed your entire position at 0.79. That's what I would do, because I was getting more than 1 to 2 risk to reward. And overall, you could have gotten somewhere around 5 RR. Let's move on to the next example. All right, so here is example 2. You can see we have a big push to the upside, and then we have a pullback, and we create this market structure shift pattern. So now we have range high, and we have range low. Why? Because lower low, lower high, lower low, and this low caused a market structure shift to the upside that broke this structure here, right? So this becomes our range low. So what happens next? Price sweeps range high. We get a fractal level market structure shift, and then we have this auto block here, right? That would have been your entry, stop right above the high, and you could have targeted the range low. And if I use the fib from range low to range high at 0.5, you could have taken one partial and going break even, right? And then you can see that at 0.79, we had a reaction to the upside as well, but then we pushed down and we took out the range low. Then you can see we came back into the range, and then we just played around this range for the rest of the day. But our move was over when we took out the range low. So we took out the range high, and then we took out the range low. That's pretty much it. Let's move on to the next example. All right, guys, so here is another example. So I want to teach you one thing. Within a range, we can form other ranges as well. So you can play with them as well, right? So for example, if we have a range, right? So we have range low and then range high over here. What can happen is we can basically form another range within that range. So this is a range, right? And this is range. So we have range low and range high. Now notice we push down with inside a range. So what does that make? This is range low inside a range. So forget about the external range. We are talking about the internal range. We have range low, price pushes back up, pull backs up, creates a higher high, higher low, higher high, market structure shifts. So that is what? A range within a range, right? So what you can do is, let's suppose if the range high is taken, you can then anticipate that the range low will be taken out first and then the range high. Did you understand what I just said? Well, I do not want to give you a lot of information. Let's just stick to the normal ranges at the moment, because this is just way too much for you in one video. Okay, so what we have, range low, price pushes back up, pulls back up, and then what do we have here, guys? The same market structure shift pattern that I told you about. So this creates our range high. So we have range low, range high. Why? Because this high caused a market structure shift to the downside. Then we have a shift in the market structure after price takes out the range high over here. We close back below the range, and we have this fair value gap. And this example is on NAS 100 because, as I said before, it works with NAS 100, other futures like E-mini, S&P, and all. So you can see we took our entry, price pushed down, and took out the range low. So now this would not work for you if we don't have any knowledge about auto blocks, right? And I want you to watch my video on auto block to understand them correctly, because if you don't know what an auto block is or what a fair value gap is, you will not be able to trade this correctly. Okay, so you can just see the video right now. You can click on it and this will take you to watch the video on the auto blocks. I'll see you guys in the next one.